What if I told you there was a perfect, risk-free way to make money? A secret formula that on paper looked like it could just print cash. Well, for decades, a puzzle just like that sat at the very heart of finance. A seemingly flawless trading strategy, backed by solid mathematics that promised a guaranteed profit. But this perfect money machine held a deep, surprising secret, one that would force us to completely rewrite the rules of math itself. So let's just dive right in and ask the big question. Can you actually build a risk-free money machine? I mean, it's the holy grail of investing, isn't it? A strategy that guarantees you make a profit, or at the very, very least, guarantees you won't lose a single penny. For a little while, it really looked like the answer was yes. Okay, so here's the blueprint. It looks a little technical, but the idea is pretty simple. You take a stock and a bond, you use the bond as your measuring stick for value, and then you just keep rebalancing your portfolio based on a specific formula. But the magic is in that last line. The theory says your final profit will be based on the squared value. And think about it. Any number squared, positive or negative, ends up positive, right? Which means, mathematically, this machine can't lose. The worst it can do is break even. And you know what? When we test this thing in a perfect theoretical world, a world where prices move in nice, smooth, predictable waves, it works like a charm. Exactly like the textbook said it would. The more often you trade, the closer your profit gets to that positive number the theory promised. This is the world of classic calculus, a world of paved roads and predictable journeys. Everything's working just as it should. Our little money machine is humming along beautifully. But, and you knew there was a but coming, right? What happens when we unplug our machine from this perfect little simulation and plug it into something that looks like, well, like the real world? What happens when pristine theory meets the jagged, messy, unpredictable chaos of an actual financial market? This right here is where our story takes a very sharp turn. So we run the exact same strategy, but this time on data that mimics a real, noisy, random stock chart. And the machine doesn't just stall out, it completely blows up. As you can see, the final value converges to a negative number. The strategy that was mathematically guaranteed not to lose money all of a sudden starts losing it. The theory doesn't just fail, it fails spectacularly. It gives us the literal opposite of what it promised. Okay, so what on earth just happened? The math was solid, the logic seemed totally flawless, but reality just gave us a completely different answer. The risk-free money machine is officially broken, and now we have to figure out why. What fundamental piece of the puzzle did we get totally wrong? Well, it turns out the problem wasn't the machine. The problem was the map. The mathematics we were using, the standard calculus of Newton and Leibniz that we all learn in school, it was designed for a smooth, predictable world. But financial markets, they don't live there. They live in a whole different territory, a territory that's defined by pure, unadulterated randomness. Let's use an analogy to really get this. Think about two kinds of trips. On the left, you have what's called bounded variation. That's like walking on a smooth, paved road. Even if it goes up and down, the total distance is finite. It's measurable. That's the world standard calculus lives in. But on the right, you have unbounded variation. This is like trying to measure the length of a rugged mountain trail, including every single tiny pebble and grain of sand. The closer you look, the more jaggedness you find, until the path's length seems to stretch towards infinity. And that is the problem. A real financial chart, like the one you're seeing, is a path of unbounded variation. It has this infinite, fractal-like jaggedness at every single scale. And that property is what breaks the rules of standard calculus and completely shatters our perfect trading strategy. We weren't just using the wrong map. We were using math designed for highways on a territory made of mountains. No wonder we crashed. So, to map this new, random territory, we needed a new tool. That tool is called Brownian motion. The best way to picture it is as a drunken walk, a path that is completely and totally random at every step. A French mathematician named Louis Bachelier had this incredible insight way back in 1900, suggesting we could use this idea to model markets. He was decades ahead of his time, but he planted the seed for a whole new way of looking at finance. So, if the old calculus breaks down, what's the fix? You can't just tweak the old rules. You have to invent a completely new kind of calculus, a calculus for chaos, one that actually embraces randomness instead of trying to pretend it doesn't exist. This was one of the great mathematical challenges of the 20th century. And the struggle to figure this out was immense. This quote from Fisher Black, one of the pioneers of modern finance, just captures the frustration perfectly. He was on the front lines trying to solve this stuff, and he knew the old tools were useless. He said he stared at the problem for months, hitting dead end after dead end. This wasn't some simple puzzle, it was a huge intellectual barrier. And here is the breakthrough. The solution came from a Japanese mathematician named Kiyoshi Ito back in the 1940s. He developed what we now call Ito's calculus. On the surface, it looks a lot like classic calculus, but it has one absolutely crucial difference, an extra correction term for randomness. It's like a built-in reality check. It accounts for that infinite jaggedness. So Ito's calculus doesn't just show us that our money machine fails, it predicts exactly why and by how much it fails. It gives us the correct negative result. The key had finally been found. Now, this wasn't just some abstract curiosity for mathematicians. The development of Ito's calculus wasn't the end of the story. It was the beginning. It provided the engine for a formula that would completely revolutionize the world of finance and unleash the quants on Wall Street. And this breakthrough wasn't a single eureka moment. It was more like a century-long relay race of discovery. It started with Bachelier's idea in 1900. Then, Ito built the mathematical machinery in the 40s. By the 60s, economists like Paul Samuelson were starting to apply these ideas. And then finally, in 1973, Fisher Black, Myron Scholes, and Robert Merton put all the pieces together, used Ito's calculus to solve the option pricing problem, and eventually won a Nobel Prize for it. And the legacy is just staggering. Ito's calculus is the engine humming inside the famous Black-Scholes formula. It is the mathematical foundation for how banks and investment firms manage risk today. It's the essential toolkit for pricing trillions of dollars in complex instruments called derivatives. And really, its arrival marked the birth of the whole quant revolution, the rise of mathematicians and physicists on Wall Street. But it's so important to keep all this in perspective. As this quote notes, these models are incredibly powerful, but they are still just models. They provide much-needed guidance in the often crazy world of finance, but they are a simplified map of a deeply complex territory. They're an idealization of reality, and we should always remember their limitations. So, a simple question about a seemingly perfect money machine led us all the way to a whole new form of calculus, one designed for the randomness of the real world. It changed finance forever, but it also leaves us with a much bigger question to chew on. What other parts of our world, from biology to physics to weather forecasting, are also secretly governed by this hidden calculus of chaos, just waiting for us to discover them?